All right, thank you very much, Claire. Well, as you know, the tax man cometh every year. Every spring, he's going to be on time with that. So what do you need to do to simplify getting that return? Because we know it can be a very arduous process sometimes. Marshall Clay with the Welsh Group joins us now with some pointers on how to make tax time less stressful. Good luck with that. Good to see you this morning, Marshall.
Good to see you. Good to see you.
But let's first talk about the returns. A lot of people, they have those chances to have some deferred opportunities, but they're not taking advantage of them.
Yeah.
So how do we do that?
Yeah, I mean, exciting times, right? I think the only people that are exciting about tax time are tax accountants.
CPAs,
and those looking for refunds, right? Those looking to get money back. But I think there's some valuable lessons that you can learn from your tax return. I think the first one is making sure that you're maximizing all those tax deferred opportunities. So what I mean by that is, those 401k deferrals, the IRAs, the Roth IRAs, most people go through the year and they don't really know what their opportunities are with their company 401k. So for 2021, the max was $19,500. That goes up a little bit.
That you can contribute to your plan.
Correct. That you can defer to your company 401k. That actually goes up to $20,500 in 2022. But when you're reviewing your tax return, make sure that if you're not taking advantage of all the maximized tax deferral opportunities, that you're doing so if you're capable of doing it. The second thing I recommend people do is look to make sure if they're itemizing their deductions or using the standard deduction. So what I mean by that is the government allows us certain itemized deductions, whether it be state and local taxes, home mortgage interest, charitable deductions, and if they add up to a certain amount that exceeds the standard deduction, then you use the itemized deduction. But what I find is a lot of people feel like they're getting a tax benefit from their home mortgage interest or charitable deductions, but their itemized deductions don't actually exceed their standard deductions, so they're not getting any tax benefit from that. Doesn't mean that they'll change their behavior or that they won't buy the home or they won't give to charity, but it's just good to know what type of tax advantages you're getting from those opportunities.
What is the threshold for that, by the way? Because it's pretty standard. I know it depends on income. But.
Yeah, so in 2021, it's actually $25,100. It goes up a little bit in 2022 to $25,900. So, look at that and make sure that you understand whether or not you're itemizing or you're using the standard deduction. And then last, and this is one that really kind of upsets a lot of people, is that there's certain investment products that you can invest in after-tax accounts. Actively managed mutual funds are really the worst on this, where you'll go through the whole year and you won't actively sell any of your investments.
Right.
But then at the end of the year, you get a big tax bill and people are scratching their head. They're saying, look, I didn't sell anything, but I still got this big capital gains distribution. And that's because of the makeup of these actively managed funds. So take a look at your tax return and see if you're realizing capital gains that you didn't affirmatively elect to realize, and it may warrant a change in your investment strategy. So that's a very important point for your viewers.
All right, some good advice there for some folks out there getting ready to file taxes. Marshall, we do appreciate it. Thank you.
All right, thank you, Mike.
All right, we'll be right back.
We took our